everybody. It is time for this week's Mortgage Minute with Tatiana Ivleva-Lopez from Prosperity Home Mortgage. Hello.
Hey,
Hello. How are you?
Good. Are you going to bring us good news? You better be bringing us good news after the news.
Yeah, the good news were all over the news. And the news is that Fed lowered their rate by half.
Yes.
So it does not have direct effect on the mortgage rates, but it actually did affect mortgage rates before they even, cut the rate, right? Because the mortgage rates were anticipating this cut. So that's why if you look, check our videos every week, I was saying in past months that rates decreased. So the same last week, or from 13th to 19th, the rates went down, and it was just because the overall economy and inflation numbers, just the same reason why Fed lowered the rates, right? Because they feel like the inflation goal of 2% is there, so they decided to do that 0.5% cut. So it did, of course, influence the mortgage rate, but it influenced it even before they did the cut.
Yeah.
And once they did it, really, there was no additional mortgage rate drop. Actually, it's somewhat like negative effect. Now rates are going slightly up, or maybe like price for the rate. So if you're shopping for rates right now, and maybe you were quoted 6% or 6.125 is no points, now you might have a little bit of like quarter of a point add on to discount points to that interest rate quote. So just, if you're looking to buy right now and you're closing sometime soon, I wouldn't recommend waiting for more rate drops, because I don't think it's gonna happen anytime soon. So, but as you can see here, the rates at 6.29 for conventional loan, FHA is at 6.06. And right here, I have a little disclosure here, disclaimer that this chart is for average interest rates, and this rate chart is provided by powered by Poly, and it actually based on scenario of 780 credit score and more than 40% down payments, or less than 60% loan to value purchase transaction. For refinances, is gonna be different.
Right.
Refinances are always slightly higher. Not bad time to look into refinancing if your rates are in high 6 or 7, especially for clients that have government programs, FHA, VA. Probably good idea to look into refi.
Okay. And I know that, Tatiana, you hit on it a lot about how the mortgage rates are not directly and in the same time related to the Fed rates, because it's based on anticipating the commentary that's out there, right?
Exactly.
But still, we have people who were on the fence for like the last couple of weeks because they hear the Feds are going to cut the rates. And then they're going to be surprised to find out that, but wait a minute, the Feds just cut the rates. Aren't the mortgage rates lower? And the way I like to think about it and explain it is kind of like, okay, in our household, we're both commission-based employees, right? Our jobs are commission-based. So if Sean and I go into contract and we've got this like really great, like say we're about to sell a $3 million house, and we know that our commission by the settlement date in 30 days is going to be this amount. Well, we might take our kids and be like, you wanted that new laptop? Well, now's the time. You're going to get your new laptop, and we're going to give them the treat, right? But then we haven't actually gotten the money yet, but when we get the money, then we're celebrating and they're like, why are you celebrating? We're like, well, that commission came in, and then they think, oh, well, do we get to go and do stuff? It's like,
You
no,
already
no,
did it.
based on the commentary, based on the surround, we already did that for you.
Yeah, yeah,
Like, we're not doing it again. And it's kind of the same thing. It's like the mortgage rates already anticipated this really good news. So you already gave everybody the benefits of that good news, that now that they've said, here's the good news, it's like, you don't get more. Right?
Exactly. Yeah, it's a very good comparison. But you know, like the problem is the media, because they like those flashy, you know, headlines that rates are dropping, rates dropped, and
Yeah.
everybody, you know, of course, people don't really understand the concept, how it works, and they think that it directly affects the interest rates.
yeah,
but
there's those
it
headlines.
doesn't.
So I gotta throw a disclaimer out there before somebody watches this and goes out and spend their money before they get their check. So we do not spend our money before we get a commission check,
That's the
and that
idea,
is the
though.
biggest way to jinx the deal. But
That's the
it's a
idea.
But
great,
some people do. Some people
Yeah.
do.
yeah, it's a great analogy, yeah.
Well,
I'm like, I don't want some new realtor to watch this, like, well, Sean and Kelly spend their money
no,
first. It's
we
totally
really
safe.
don't. Like, we're very serious.
Well, but on the contrary, you already spent the money, so they better not to change their mind about buying the house.
Right, that's it.
That's right. But now, okay, so correct me if I'm wrong, but I can anticipate this affecting the Fed's change. That will affect my HELOC rate though, right?
Exactly, exactly.
Okay.
So that's what's gonna get affected. So if somebody has home equity line of credit, it always tied to the prime rate, the rate that Federal Reserve changes, right? So now people with HELOCs will see their payment going down, because by 0.5%, the rate will improve by 0.5%.
Okay.
That's nice, yeah.
Exactly.
But then also my high yield interest account might go down. too.
Yep.
Wow.
And the next meeting is November, right?
I believe it's gonna be in December. They were planning to do the another cut in December.
Okay, okay. All right, very good.
So we'll see
Yeah.
what happens.
Thank
So,
you.
I have a question for you, and hopefully you have a PowerPoint for this, but, we have a client that you're working with, and you had mentioned to them, they were exploring whether they needed to sell their house before they could buy the next house, a bigger house. And you mentioned to them the option of recasting a loan. And, we've never done a client transaction with a recast. We both know what it is, but I would really love it if you would kind of explain that so that people would understand what that option is.
Yeah, I don't have a slide for it, but I was just thinking I can try to explain it
That's totally fine. I
as
just
well
wanted
as
to lay that
possible.
out there, like, we're acting like this is spontaneous,
Yeah.
and then you pull up a PowerPoint, just like, okay, yes, we planned
Your
it.
mind this time.
All right, so yeah, so explain to us what a recast is, how that works.
So recast is basically a recalculation of a monthly mortgage payment after a large sum of money were put into principal.
Okay,
That's my definition of that. So basically, just a background on that. So most of the loans have option of paying extra to principal without being penalized, right? So
Right.
your payment is 3,000, but you can put extra 1,000 into principal. So this way, what will happen is your payment is not gonna change, but you will shorten your term on the mortgage. You will pay it off faster, you'll save on interest and all that good stuff,
Right.
but the mortgage payment will stay the same.
Right.
So, but the recasting is option of lowering your mortgage payment after you put extra money into principal.
okay,
And it's allowed on conventional financing. FHAV does not allow that. But also when you work with lender, you need to double check if that particular lender or servicer will allow that recasting, and also, what the terms are, because sometimes they'll say that you have to put at least 20% of the balance into principal in order for them to recast you. For example, if your balance right now is 500,000, they want you to put at least 100,000 for them to do that payment recalculation. Some say it's 10%, so it's gonna vary depending on the servicer, the lender, and how much it costs also could vary, but typically it's inexpensive. So you don't need to do a refinance, right? If you have that extra 100,000, you just typically the procedure is that you let the lender know, the customer service, that that's what I'm planning on doing. And typically they ask you to put it in writing. It's kind of like an agreement, and they'll tell you, okay, so if you put 100,000, we're going to recast it. You're not gonna shorten your term anymore, right? You still gonna have that 30 years or 29, whatever you're at right now, years left, but we're gonna lower your payment, and the payment is going to be X, and it's going to cost you this much. And typically it's just a couple of $100 that you have to pay.
Okay.
Yeah,
Okay, so strategically and tactically, a buyer might use this if they, let's say they live in $1 million house and they want to buy a $2 million house. They can afford and qualify for the $2 million house, but they don't want to carry the mortgage that it would take putting 20% down. They'd like to sell the $1 million house and apply that equity to the loan. So instead of having to sell that house first, they could go ahead and get the $200,000 house, sell the $1 million house, whatever they net from that, then put it into the mortgage and lower that payment down as if they had had that money in the first place to put down on the house and have that.
Exactly. That's how it works, and that's what we're doing with your client, right? So they basically, they don't want to be contingent on selling the home, right?
Exactly.
And they're going to put, but they have a lot of equity in current home, but they don't have this much money to put into the new house. So they're gonna put, let's say, 100,000 or 200,000, and the payment is gonna be pretty high. They're not comfortable with this payment, but it's just a temporary solution. So they buy this house with 200 down payment, and once they sell the current home and will net 400,000, they're just gonna throw this 400 into the new house and recast that payment and have a much more comfortable monthly payment.
Now, when
I have a
they,
question.
okay,
May I?
it's probably the same question I have, so go.
Okay.
If you know
Do,
it's
do they have to qualify, like based on DTI and everything, at this big amount? And it's just that they simply don't want that big amount? Okay.
Exactly. Yes.
So they cannot do, like, their numbers have to work and qualify now, not based on just an agreement that when we sell it, we're gonna do it, and then it would qualify. They have to qualify immediately.
Exactly. So I have to qualify them carrying both mortgages.
Okay.
The current one plus the new one at whatever it comes with 200,000 down payment.
Okay.
Now we do have non-qualified, non-QM type of mortgages available if person does not qualify carrying for this scenario, carrying two mortgages. There are some programs, not regular conventional, but special investor loans that investors provide, where I won't count payment on existing home if that home is for sale right now. So you put it for sale, but you're not gonna settle before you buy this new home yet. So we won't count that payment against the client because we know they're gonna sell it soon. But that's a specialty loan. It's not regular Fannie Freddie or regular jumbo traditional loans. It's something separate. But if you're talking about regular loans, yeah, you have to qualify both.
Okay. If they did qualify for that bigger property, let's say they qualified and they were only able to put 10% down, and let's say the interest rate was 6%, but because they're putting 10% down, now it's 6.5%. When they sell the current home and they can put that extra 400,000 to it, can the interest rate drop, or
Like
is they
in the
gonna
recasting?
in the recasting, can they recalculate it like, hey, we put 40% down versus just 10%, or are they keeping that interest rate and they're just
Right, like
recasting
the
it over?
total recast.
No, then they just need to do refinance then it
Okay,
would
so
be
they're not gonna change
refinance.
interest rate by putting
The
that money.
rate is not, yeah, recasting it's purely just recalculating payment based on current terms.
Okay, got it.
Okay.
Yes,
Okay.
so, and that's when, that, token comes into play, right? I tell them, if you put 10% down, this is your rate. If you put 20% down, this is a different rate. So, and then they're gonna decide, okay, well, then we'll have to refinance and we don't wanna do that. Then we'll just gonna try to get this new property being contingent on a sale. But
Yeah.
in a lot of cases, honestly, the rate is exactly the same. If you put 10 or 20% down, it's when you start going like really, really low, 50% down or so, then you might see some improvement. But then, they'll see, does it even make any difference? Okay, the rate is an eighth better, 0.125% better. Does it, it even it worth the trouble of us trying to get under contract, being contingent, and maybe it's not as easy, right? And maybe there is this home of their dreams and they don't want to lose it, and they're gonna lose it because of that 0.125% difference.
Yeah.
So you just see what makes more sense financially
Yeah.
for
For them, because some people have a huge amount of money they're setting on with lower monthly income, and some people don't have the money that they're setting on, and maybe they're expecting a huge like salary bump or whatever. It's like that comes to really talking to you, the loan officer, for you to plug all the different things and make sure that it like you're giving them the absolute best case scenario for them.
Yep.
And their property. So
exactly.
so
I'll give them few scenarios and then they'll decide, make that educated decision, right?
Yeah.
On
That's
which
right,
one
right.
is
Yeah.
better for them.
That's right. That's right. And it always comes down to what works for them. I mean, those scenarios can be so different, and it could be the exact same scenario for two different people, but their goals are different, or their
Yeah.
risk tolerance, or their
Yeah.
motivation.
Or their timelines, their time
Yeah.
in life. I mean, everything,
Yeah.
we've been in different places and in our lives in so many different
Yeah.
areas. So,
Absolutely.
yeah.
Okay. All right. Thank you. That was a great explanation.
Yeah.
Appreciate it.
You're welcome.
Anybody has any questions? How do they get in touch with you?
They can call me at 571-245-3000.
Did you have to fight not saying it?
Yeah, because I keep seeing like a jingle, 571-3000.
Maybe you need to come up with little tune and I'll sing a thing.
Yeah.
There you go. You got to sing it every time. All right. Okay. Well, we'll see you on next week's video.
Yes, we'll see you soon. Bye.